Welcome to Lesson 1, Introduction to Accounting. This is Accounting Made Simple, and let's get started. What is accounting? Accounting is a way of recording, analyzing and summarizing transactions of an entity. Cool. There are 3 types of business entity. One is sole trader. The other one is partnerships, and we've got limited liability companies. So sole traders are owned and operated by one person. They are fully and personally liable for all losses. That means that, let's say I opened up a shop, a normal Jeffrey opened up a shop, right? He called it, I don't know, shop 1, and then his shop closed down. He would be fully liable for all the losses. The common examples of sole traders are corner shops, plumbers and hairdressers. So they're basically like self-employed people. Moving on to partnerships, they are owned and operated by 2 or more people. Partnerships can be general partnerships or limited liability partnerships, which I'll explain in a different video. Common examples of partnerships are doctors, lawyers and accountants. Limited liability companies. These are owned by multiple shareholders with limited liability, meaning their financial responsibility is restricted to the amount outstanding on their shares. This can be privately owned, Ltd, or publicly owned, PLC. They are managed by directors. The common examples of these are large corporations and businesses. Okay, that's all of the 3 different entities covered. As you can see on the bottom, you have to remember this is very important. Asset equals liabilities plus equities. Asset minus liability equals to equity. Net asset is equity, and there's a little note that I put down. All these formulas will be used in your statement of financial position, so make sure to remember those. Okay, next. Asset classifications. A non-current asset is an asset held by the company for 12 months or more. On the other hand, a current asset is when the company holds the assets for 12 months or less. Now, you can pause the video. On the right hand side you can see all you have to do is classify what a van will be, what a machine is, what a car is, and what an investment are, if they're current or non-current assets. You can pause this video, attempt it. Okay, so now that you've done attempting these questions that I gave you, let's quickly run through them. A van, it would be a non-current asset as it is for delivery firm, and it will last for 12 months or more. Machinery is a non-current asset as they're using machine to manufacture, so it will be held for long term. And a car. Cars you are trying to sell, this is inventory and is a current asset because you're buying it to sell it. Realistically, this specific company or any company won't hold inventory for more than a year. Investment depends because you can either hold it for long term or short term depending on your circumstance. For example, let's say that the business is uncertain and they most likely would take the money out from their investments if they need it. And invoices and credit notes. Sales and invoices are the key source documents for credit transactions. Your business has invoiced your customer and they ought to pay it, but we all know customer has a right to return the goods due to reasons like it could be faulty. What do we do then if it's already written off in the system? A business can issue a credit note. A credit note are a source document, and on the other hand, remember, debit note are not a source document. Anyways, carrying on with credit notes, they are documents issued to customers relating to returning goods or refunds. So let's say a customer wants to refund their goods. Let's say they bought a couple things from your company for £100 and they want to refund £20 worth of stuff, maybe clothes that they bought. A credit note will be issued, and instead of credit notes, you may have come across debit notes. Credit notes are issued to customers when they return the goods. So debit notes are issued to the suppliers when we probably return the goods to the suppliers, to them. So we need a credit note from them, right? We need a negative invoice from them. To request a credit note from a supplier, a debit note is sent. This is something we have to be aware of, as sometimes we come across credit notes and sometimes we can come across debit notes. Debit note is not a source document. A credit note is a source document as you agree to refund. This will impact your payable, it would reduce it. Alright, moving on to the next section. Capital and revenue expenditure. So, here are the definitions and examples of it. You can quickly read through them. Revenue expenditure is day-to-day costs running the business, wages, rent, repairs, etc. Capital expenditure is spending that results in acquiring non-current assets or improving, enhancing their earning capacity, for example, upgrading equipment, buying machinery so that it can continue running and continue producing and manufacturing the product. Revenue income, income from normal trading activities. Examples are sale of goods held for resale, provision of services, interest and dividends from investments. Also, remember that dividends are paid from a company's retained earnings. Capital income, income from non-trading or financial activities, that is sales of non-current assets, land, building, machinery, issues of shares, loans received. Now let's move on to ledgers. Ledger account record and analyze individual transactions of a business. Each transaction will be dated and recorded in chronological order. The ledger then can build up totals for each day, week, month or year. This is saying the ledger under the ledger books, one of the accounts will be cash, right? So any transaction that affects cash will be recorded in the cash ledger. Cash account is one account. Every single transaction that affects cash will be recorded so that if the business wishes, it can generate a total of the cash account on the daily, weekly, monthly, whatever basis it wants. Then of course, this will be used for the statement of financial position and statement of profit or loss. All of these items should have accounts in the ledger because eventually those numbers in the statements are from processing the information we already recorded in the ledger. Ledger account take the form of a T account. So basically it's a big T, as you can see here. On the top of the ledger account we have the name, such as cash. It can be inventory, motor vehicle, buildings, rent. The name could be anything up here. And then we've got the left hand side and the right hand side. The left hand side is debit and the right hand side is credit. For every T account we always have a debit on the left and credit on the right, which means from now on we'll say debit something or credit something, right? This means if we are saying debit cash, it means that debit cash £100, that £100 need to be put in the debit side, and if we say credit cash 100, that cash of £100 needs to be put in the credit side of the cash T account. When we put the £100, we just don't only put that in the T account. We also need to put the date and the narrative. And if you have a reference, we can put that in. Now, let's move on to the nominal ledger. There are three main ledgers in accounting: the nominal ledger, the trade receivable ledger, and the trade payable ledger. The nominal ledger records most items such as income, expenses, assets, liabilities, and even the cash account. The trade receivable ledger contains a separate T account for each customer to track how much money they owe, while the other trade payable ledger has a T account for each supplier to show how much the business owes them. We use these ledgers to record and analyze all financial transactions, with each transaction entered into the appropriate T account, making it easier to organize and understand the financial position of the business. When we record a financial transaction into a T account, let's say under a nominal ledger or under the trade receivable ledger, and you can imagine this as a big T account, but it is not, as each customer will have a T account in trade receivables, and for trade payable, each supplier will have a T account. Any T account will be similar to the cash T account I have shown, so we use the T account to record individual transactions. Now let's talk about DEADCLIC. This is one part that you will have to memorize, and there is a magic word to remember, which is DEADCLIC. So in this table we have debit on the left side and credit on the right side, and this is not a T account. All of these items we put in the left side says increase. That means for expenses, if we are debiting expenses, that expense is increased. If we are debiting an asset, that asset is increased. If we are debiting drawings is increased. Yeah? And if we are crediting liability, the liability increases. Income and capital, if we are crediting income or capital account, those two items are increased. Below you can see expenses are rent and salaries, assets are cash and bank. Yep, cash is part of an asset. Buildings and equipment. Drawings is when the owner takes money out of the business. Liabilities, this is when the business, remember you're looking at it from a business perspective, so when the business owes money to other suppliers, such as loans, account payable, these are liabilities. Income, these are earned by the businesses, example sale revenue and investment income, for example. Equity, these include share capital, retained earnings, and owner's capital. Okay, now I want you to complete this and put your answers in the comments. Let me know how many of these you got right. Okay, let me just do the first one for you. So let's look at the purchase of books. So this is something that's okay if you're unsure. This is something that affects purchases, and the other side is going to be affected by this is payment. Payment is not in cash, it's actually on credit, and this is a bookshop, so this is certainly a payable. If a business buys something on a credit, it is always a payable. The purchase is on credit, so the company owes money to its supplier. So remember when we talked about DEADCLIC on the previous slide? This is a liability, and when a liability increase, they are credited. So this trade payable should be on the credit side, and the purchases should be on the debit side. Alright, that's it for today's lesson. For homework, write down your answers to the question I asked in the comments below. Also, let me know how useful you found this video. It will help me make my content better. And also, don't forget to like and subscribe if you found this helpful. See you in the next video.